Welcome to the Allan Small Financial Show. As always, I want to thank everybody for taking the time out of your busy day and spending some time with us. It's always a good opportunity or a good time to have a show during the same week as the largest IPO in history is about to happen. As I'm sure most of you know, SpaceX will become the largest company to go public, IPOing on Friday, this coming Friday. The estimates are about $1.5 trillion in terms of size, and it promises to be a fantastic event, a very volatile event, something that investors have been asking me about for weeks now, and something we're going to touch on this show today. But let's actually look at what we're going to be talking about for today's show, other than the SpaceX IPO. And there you have it, our topics for today. Great markets produce two types of investors. And it's interesting, we have one market, a very good market over the last few months, yet two types of schools of thought, or two types of investors that are producing two types of investors right now. Top three things to consider over the next 5 to 10 business days. As always, very popular part of our show where we talk about three things that I think individual investors need to be focused on before you make your investment decisions with your portfolio. Oil industry warns of price hikes, worry about low oil reserves. And this is coming out of the oil companies themselves. They're seeing that price of oil can only go one way, but higher from here, even though we've seen the price of oil already move higher. Prior to the war, oil was in the low 60s per barrel, WTI. Today, it sits in and around 90, 95, fluctuating. I know today there's been some news out of the Middle East, again, looking towards perhaps some new conflict there. We've seen some bombings overnight, so price of oil is slightly higher, I think just under $90 right now. Canada slips into a technical recession. Yes, Canada, in theory, is in a recession. Now, I always joke around and say, do you feel any different than you did a month ago when Canada wasn't in a recession, or a few months ago when Canada was not considered to being in a recession? The answer is no. And that's why we call it a technical recession, because there is a way we calculate, or we can tell when our country is in recession, and that's 2 negative quarters of growth, or GDP. And we just received the second negative quarter. We're going to talk about that a lot more. Stocks drive record share of American wealth. We're noticing that a lot of wealth now in households are basically being driven by the stock market, and talk about reasons why that's happening. 33% of household wealth is now tied to the stock market. Highest point in history since we've been keeping track. Quick hits, three things that I've seen in the news recently that I wanted to comment on. Some of the things you probably know yourselves and seen in the news yourselves. We'll touch on those as well. And last but not least, your questions. I'm going to touch on your questions. If you have any questions during the course of the show, please put them in the chat boxes. We will go around and pick up those questions and hopefully answer some of them at the end of the show. If not, we'll answer them on our show perhaps the next time in 2 weeks, or perhaps I will send a message to the person during the next 2 weeks and answer them directly with that person. So please, if you have any questions, something that is on your mind, please feel free to put those in our chat boxes. So without further ado, let's move on to our first topic, which is all about the investor and today's markets. So as I said off the top of the show, we have one market that is doing extremely well and has been doing extremely well. Over the last, let's call it week or so, we've started to see a little bit more volatility. We've seen some sell-offs in some of the big powerhouse positions. I call them powerhouse positions because we know that the stock market has been led by maybe 20 stocks in the US, let's say, and the S&P 500. 20 companies have been outperforming, and that has been really taking the S&P 500 a lot higher. And at times, we've actually seen more companies down than higher, yet the stock market is still moving higher because of the size of the companies that are moving higher. It's being dominated by the large cap tech names, and that's been going on now for quite some time. So one market doing fairly well, yet different ways of thinking from investors, two types of thought that we're seeing or I'm encountering with individual investors. And I wanted to touch on these two ways of thinking and kind of give you my idea as to how I'm thinking and what I believe investors should be thinking or how they should be thinking going forward. So our first illustration here, we have the North American market returns, and we have two charts, the S&P TSX. So the TSX, Toronto Stock Exchange, the NASDAQ, you can see charts, both of them slightly different. TSX is more taking a more of a gradual a move higher, still some ups and downs, but gradual, whereas the NASDAQ, very abrupt since April, and we've seen a pretty large and significant move higher. TSX for the year as of June 9th, up 9.5%. NASDAQ up 10.5%. S&P up just under 8. Dow Jones around 6. And you can see the one-year returns on the far right-hand side. Our next chart shows the same numbers, but two different graphs, right? You have the S&P 500 on the left and the Dow Jones on the right. Again, very similar to the NASDAQ, really starting to take off after the war broke out, beginning of March. By April, we were seeing markets turning around April and May and rebounding significantly. So this rebound, as I said, has created two schools of thought. The first investor or way of thinking was, or has been, the markets are doing so well. I'm starting to get a little bit nervous. Maybe I should pull my money out of the market and put it on the sidelines and then, move back into the market when things are a little bit more calm, or maybe we see a bit of a pullback in the markets. And, if we lose out on a few percent return, that's okay. We can lose out on a few percent return, but then get in shortly after. And as I've talked about many, many times on this show, that's called market timing. And in my opinion, investors that market time usually end the short end of the stick, get the short end of the stick. And when markets are moving higher, significantly higher over periods of time, it really is the market timers that are the ones that lose out. They're the ones that tend to see returns that aren't as high as those investors that, buy good quality and own that quality and not try and time the markets, or at the very least, move some money around. So our first illustration shows exactly this. We've seen variations of this chart before. Missing top performing days can hurt your returns. And I know it's hard for everybody to see the letters or the words on the bottom, but on the far left-hand side, so this is $10,000 invested, hypothetical $10,000 invested. If you were to stay invested over the last, I believe it is 20 years, your $10,000 would be worth $84,580. And this is the S&P 500 index, of course. If you miss just 5 days, just the 5 best days in 20 years, your returns would drop from $84,000 to $52,240, a significant drop. 5 days out of 20 years. How many days are in 20 years? You can do the math and figure it out. It's a lot of days. If you were to miss just the best 10 days, your returns fall to $37,000. 15 days, $28,000. Miss the best 20 days only, $22,000. And if you miss the best 25 days over 20 years, your investments would still go up, but from $10,000 to $17,000 versus $84,000. So when individual investors talk to me and they say, Allan, you know what? Maybe I'm a little jittery. Maybe I'm a little concerned, maybe a little nervous. Let's put some money on the sidelines. Let's get out of this market for now to move back in later. This chart is the most powerful illustration why you just can't do that. Yes, you can take some profits, but you want to stay in this market. There's no doubt about that. And this chart clearly shows exactly the reasons why. Our next chart, growth of 1,000 in the U.S. stock market since 1926. So a long period of time, 100 years roughly. You can see here a lot of ups and downs. We have Great Depression, World War II, Korean War, Black Monday, tech bubble bursting, SARS, global financial crisis, COVID. All of that has happened in the last 100 years, yet look at where your money would be today. So again, another powerful illustration why you stay the course, you own good quality, and you don't get out of this market. And That is my main message that I give to many investors on a regular basis, because even though they don't even realize they're trying to time the market, that's exactly what they are doing. So that's the first type of investor. You're getting a little jittery. Markets have been rising very, very fast. Probably the best 2 month period, which was April and May, that many have seen in their careers. And I'm one of them. I don't recall a 2 month period to see the gains that we've had during the last couple of months. Then we move to the other school of thought, or the other type of investor, and they're on the other side of the coin. They're going to let it all ride. I think this market's going to go on forever. There's a shortage of chips, a shortage of memory chips. Why would Micron fall? Why would other memory chip companies fall? Western digital storage companies. Why would big cap tech ever fall? This AI boom is in its early stages. We're going to see years and years of growth. Why would I sell this stock? Why would I trim profits? Why wouldn't I just let it all ride? And that is kind of on the other side of the spectrum. And there are reasons why you shouldn't do that either. Our first chart is actually of gold. And I probably had this question. There it is. Question asked of me about gold. Why don't we own gold? Should I be buying gold? Gold hit about $5,500, $5,600 an ounce not that long ago. You can see it here on the chart over the last year. And today it is under $4,200 an ounce, US dollars. So clearly, gold had a tremendous run. Many people thought that the run would continue, that the United States would lower interest rates, the dollar would weaken, and gold would continue to run higher. Clearly, that has not happened. It looks like the United States isn't going to cut, I should say, interest rates anytime soon. And the US dollar has gained strength across, versus many other currencies around the world. And we've seen a strengthening US dollar, and gold has paid the price. Gold is down over 20% from the high. So again, let it all ride. Probably not a good idea. Those that would have trimmed some of the profits at the top or near the top or at any point in time on the way higher, that was probably the better move to make. Our next chart is Micron. I mentioned it just a moment ago. Micron makes memory chips for memory. You need memory. You need to store things in, and you need to have memory with pretty much everything. Data centers, computers, everything has memory built in. And you can see, if you were someone to say, hey, Micron, I've seen a lot of price target increases, 1,200, 1,300 price targets. We just saw them in the last few weeks. Yet look where Micron trades today, under $900 a share. It's actually a little bit above that right now. Actually, just over 900 right now. 935 it reached a high the other day. And at one point, it was well over $1,000. So you want to let it all ride and not trim some of your profits? That's what's going to happen at times. Even the best companies. This company became $1 trillion in market cap recently and have since pulled back a little bit. Nothing runs straight in a straight line to the moon, and things have their day. Stocks have their day. There will be points in time where stocks pull back. Micron is no different. Western Digital, another company in storage and memory. If you liked Western Digital, we have a chart of Western Digital. Look what Western Digital has done recently. Stock price has gone to the moon, but now it's kind of come back a little bit, just like Micron has. Letting it all ride and not taking profits probably wasn't a good idea. Now, I'm not saying Western Digital and Micron cannot surge higher again, but you always want to take a little bit off the table and reinvest those profits somewhere else along the way. Next chart, Dell Technologies. Dell has had a tremendous run. Look at that, almost straight line higher. And now Dell, too, has gradually started to work its way down. Last chart here we have is one of AMD, Advanced Micro Devices, another stock that has gone straight up at one point. And look at AMD. AMD is down by about $100 now from its previous high. So letting it all ride, in my opinion, isn't really the best way to go. Selling out completely and sitting on the sidelines, probably or most definitely not the way to go. So what do you want to do? Combination, somewhere in the middle. You want to trim your profits. You want to take those profits and reinvest them into other stocks or other investment ideas that you think have the potential to be tomorrow's winners, not yesterday's winners, tomorrow's winners. You want to buy good quality. You want to trim that quality investment once it's run higher, once it becomes an oversized position in your portfolio. Remember, you want to remain in balance. You want to have a balanced portfolio. And sometimes the Microns, the Western Digitals, the Dells, and the Nvidias, and many others became oversized, too big. And you need to trim some of those profits, get everything in order, get things back in a balance, and then take those profits and maybe buy another idea, investment idea, stock idea, an ETF or mutual fund, or even a bond if you want to start producing or buying some lower risk interest paying investment ideas. So that is what I think individual investors should be doing. You don't, I know we're producing these two separate or totally different types of investors right now as this market is continuing to rise. But I say be in the middle, always stay balanced, and at all times own good quality. Now the part of our show, very popular part of our show, we talk about three things individual investors need to focus on before they make their investment decisions. First one, inflation updates. We just got an update today on inflation out of the US. CPI was reported. We'll touch on that shortly. PPI, which is producer price index or wholesale prices, will come out tomorrow. Very, very important. This is definitely market moving. Interest rates, also market moving. We received the Bank of Canada rate announcement this morning. Bank of Canada, as anticipated, decided to hold rates steady. We're going to get the Federal Reserve interest rate announcement next week. It's actually the first announcement by Kevin Warsh, the new head of the Fed. We'll see how he handles the media, all the questions that are going to come out with respect to interest rates and what their plan is. SpaceX IPO this Friday, as I mentioned off top of the show. Will this be the top of the market? And I say this because there's been a lot of chatter about investments being sold off to raise capital to buy SpaceX when it goes public on Friday. Perhaps that's also one of the reasons why, along with a few others, the war in the Middle East, etc., why we've seen some jittery markets this week. Maybe it's some investors trimming some of the profits on some of the high flyers of the last couple of months and I guess creating cash or accumulating cash to move into SpaceX IPO when it happens on Friday. So let's move to our first topic or our first point to consider before you make your investment decisions, and that is CPI and PPI. CPI, Consumer Price Index, it is the inflation gauge for the United States, for Canada, for everybody. And we received numbers out of the US this morning. Let's put up our first chart. And we could see that, yes, CPI is moving higher, 4.2%. It's the first time we've seen the number with a 4 in front of it in a while. We're also seeing core CPI, which is less food and energy, moving higher towards 3% now. But the thing I notice about this chart is the difference between headline and core. Core removes volatile food and energy prices, whereas the headline accounts for everything. Look at the difference, and that difference clearly is because of the higher price of oil today has factored in. But clearly, on a positive note, it hasn't seeped into higher oil prices have not moved into or seeped into other aspects of our life. So oil prices are moving up, core CPI is moving up with it, but still not at a point where it starts to make analysts, economists, investors nervous. I know the market actually this morning ticked higher when CPI data was released out of the US, and that was interesting to see, even though numbers actually came in right on expectation. We were expecting 4.2, we got 4.2, we were expecting 2.9 on core, and we had that as well. Our next chart shows that PPI, actually, which will be released tomorrow. That's our next chart. There you have it. And I guess that, again, look at the difference between the headline and the core. 6% headline, well above where it is on CPI, and core, obviously a lot higher as well. But look at the difference between the two. Look how much oil is factoring in into the headline number versus the CPI number, and that is important. It's important to know. We'll see what PPI looks like tomorrow. Any inflation data that comes out at any point in time going forward, definitely market moving. It will affect interest rates, which we're going to touch on in a second. It affects obviously spending, consumer spending, which we know in the US, 70% of the economy is due or is made up of the consumer spend. We know that the consumer drives the US economy. The US consumer drives the global economy, as a matter of fact. And so obviously when prices are higher, that affects everything. So something to be mindful of and keep in the back of your mind to consider before you choose your investments. Next topic, interest rates. And interest rates are important. When we received data last week, jobs data, and it was very strong, both out of Canada and the US, a lot more jobs created for the month of May than anticipated. What happened? Well, it was anticipated that the Fed was going to cut rates this year, but with such strong jobs numbers all of a sudden out of the US, the Fed, at least it's thought that the Fed would now focus on its second mandate, which is higher inflation versus creating jobs, because jobs appears like it doesn't need to be created, that their jobs growth is just fine. So when you focus on inflation, what happens usually is the Fed will consider raising interest rates. And now, whereas we all priced in interest rate cuts for this year, now the market is actually pricing in 1 or 2 interest rate increases by the Fed this year. And what that meant was strong jobs, perhaps higher interest rates to come. And we saw interest rates move significantly higher last week. And we're going to show a couple of charts in a moment, but interest rates have been moving higher for a little while now, and usually a negative for stock market, although we have seen at times both interest rates move higher and the stock move higher with it. Let's look at our first chart, Bank of Canada policy interest rates. You can see it really hasn't moved much, and the Bank of Canada announced today, as you can see, June 10th, 2.25%. Do I agree with it? As many of you know, I do not. I think we should be lower. Yes, there are inflationary pressures, but there are also growth pressures as well. Our next chart shows the bond market running ahead of the Fed rate policy, or perhaps an increase in rate policy. And this is an interesting chart. And what this tells you is that the gold line is the US 2-year yield, and the Fed funds effective rate is the black line. So you can now see that the 2-year bond rate, or the 2-year yield, is actually above the Fed funds rate right now, which doesn't happen often. And what that tells all of us is that the market is anticipating an interest rate increase by the Federal Reserve or in the United States. And how do we know that? Because the 2-year short-term rates, at any point in time, US, Canada, it doesn't matter, they're very much affected by what the Bank of Canada does, what the Federal Reserve does. It's the long-term rates. It's the 30-year, for example, that is not really affected, at least directly, by what the Fed does. It's more affected by what the market thinks and how the market interprets what's going on in the world. So the Fed has a hard time influencing the 30-year, but definitely has effect on the 2-year. And this is telling me that the Fed, very good chance, the Fed could raise rates before the end of the year. Our next chart, Federal Reserve policy interest rate. You can see that the Fed, again, has been holding tight. You can see interest rates came down, but in the last few meetings, the Fed rate has come down. Sorry, has stayed the same. Next chart we're going to show is the 10-year Treasury. And this is what I was alluding to just a moment ago. 10-year Treasury rate, you could see, yes, it's gone up. It's gone down a little bit over the last little while, but as of March to today, bottom left to the top right, the 10-year has definitely moved higher. I've seen it as high as 470, I believe, at one point, which is extremely high. You know, earlier on, we were seeing the 10-year under 4, and now it's up to 4.5. And as I said, I've seen as high as 4.6, 4.7. Next chart is the 30-year US Treasury. Again, this rate I've seen well over 5%. I've seen it a lot under 5%. Today, it's in and around 5%. But if you look at what the market is telling us, it's telling us that the 30-year is going to move higher. And again, or has been moving higher. It's going to move higher if uh, uh, things to continue and inflation remains high and costs remain elevated. And we don't get interest rate cuts this year out of the Fed. If we get interest rate increases, I believe the 30-year can move higher. Hopefully, that's not the case. As I said, stock market doesn't like higher yields. Next chart, Government of Canada bond. This is also wanted to show you what's happening in Canada. And this is a 10-year Government of Canada bond rate. There you have it. Also moving up since March, came down in May, and then right back up towards the end of May. And so interest rates moving up in general, and that's based on a fear of a few things. One, inflation, Middle East not helping, higher oil prices, and also that the central banks would consider moving interest rates higher, which will, again, as I said, affects more the short term, but the longer term rates will be indirectly affected as well. So interest rates, something to focus on before you make your investment decisions. Our third topic, and one that I think everybody's excited about and asking about, and is there you have it, SpaceX IPO, Elon Musk's company. There's talk that this addressable market for SpaceX, so the market itself for what SpaceX does, $16 trillion. And when you think about SpaceX and the monopoly basically that SpaceX has at this time, yeah, we have Blue Origin, company from Jeff Bezos, former CEO of Amazon. He has Blue Origin, I guess maybe a bit of a rival to SpaceX, but SpaceX with their satellites and their going into space, and Elon Musk talks about putting data centers on the moon and putting space centers on the moon and all the different things, the AI and all that stuff that goes into SpaceX, and it's just truly unbelievable. And everybody is excited about SpaceX, and they will trade publicly. Looks like this Friday. The stock will price late Thursday night and open for everybody to buy if they want come Friday. Now, would you be a buyer? Would you not be a buyer? Well, interesting chart we have here. Our first chart shows that most IPOs don't make it to the moon. And on the far side, you have the red bar. And that tells you that, if you can read it there, that IPOs are down more than 50% of the time. It looks like 3 years after buying at the first close, 60% of IPOs were flat or down, while only 16% more than doubled. So you can see that there's a pretty good chance that the IPO or a stock that goes public 3 years later probably hasn't done as well as you may have thought. And everybody gets excited about these IPOs, but what tends to happen is you get a pretty large initial run higher, followed by individuals coming in and saying, well, maybe the company isn't worth as much as we thought originally. Perhaps this is more of a longer term story. Stock sells off and then kind of flatlines for a bit before perhaps moving higher later on down the road. Now, I will say that SpaceX is not a regular company and is not a regular run-of-the-mill IPO that you're going to see. The way it IPO'd is different, and just SpaceX, the size is different. Largest company to go public in history, $1.7 trillion is what the market cap looks to be of a company that makes no money, right? SpaceX makes no money at this point in time. They spend more money than they make. Obviously, that can change very quickly. We've seen that happen with another Elon Musk company, Tesla. They didn't make money for quite some time, and all of a sudden, one day, they started making money, and the stock went significantly higher, and they too are a $1 trillion market cap company. Our next chart shows where SpaceX would fit in with respect to the largest companies in the world. SpaceX would rank near Saudi Aramco if it achieves its target price tag of $1.7 trillion. World's most valuable companies by approximate market cap. You can see NVIDIA over 5 trillion, Apple 4.5 with Google, Microsoft, Amazon, Broadcom, Taiwan Semiconductor, largest chip maker in the world. Customer, NVIDIA is their biggest customer, of course. They make chips for NVIDIA. And there you have Saudi Aramco, oil company, largest in Saudi Arabia. Then you have Tesla, and last but not least, Meta, or formerly Facebook. So a very big day on Friday. Could investors be pulling money out of their investments, perhaps tech stocks or other things, to buy SpaceX? It is quite possible. If that is happening, then that is a possible reason for why you're seeing the stock market as volatile as we've seen it. Many people believe that we need to get through this Friday before the market can move higher once again. Some people believe that Friday could be the top of the market because SpaceX will dominate so much. I would be more on the side of that we need to get through this Friday to see the market move higher, not lower. And keep in mind, later on this year, we're going to see Anthropic, OpenAI, two large AI companies go public as well. Where is the money going to come from for those stocks, for those people, investors that want to buy those stocks? So all this will play a factor later on. But today and for this week, SpaceX is the name you want to focus on. It will be market moving, and along with interest rates and inflation, these are the three things that I think individual investors need to focus on before you make your investment decisions. Oil industry, warning of price hikes. And we've been hearing these warnings really since the war broke out in the Middle East. I think WTI oil got as high as 116, in that 116, 120 range. Today, in and around $90. So will the price of oil move higher once again? Difficult to say. I think there's a lot of oil in the world. There's a lot of reserves in the world of oil. And we know that countries are starting to use a different route to get their oil. Even the countries in the Middle East, whether you're UAE, whether you are Iraq, you're starting to, Saudi Arabia, another example, starting to use other ways to get the oil out past the Strait of Hormuz, using pipelines in other parts of the country, moving oil to other parts of the country through other borders and crossings, and getting it out to port in different ways. And so that is also helping. We're also hearing that more and more tankers are being able to leave the Strait of Hormuz. So traffic is flowing a little bit better. By no means where it was prior to the war, but definitely a lot better. So a lot of conflicting messages. On one hand, oil reserves are falling. Price of amount of oil being produced and sent around the world for countries that need it is a lot less. So therefore, we should see a higher price of oil. But because countries in OPEC, which has recently announced another increase in production, because there's a lot of oil out there, United States contributing with 13.7 million barrels a day. This is why the price of oil has been hanging in. Many people believe that oil should be a lot higher based on the risks of another attack or the war re-engaging and combat happening again. I'm not so sure that's going to happen, but hopefully we can get some sort of a peace initiative or peace talks happening. Our first chart here shows U.S. oil reserves fall to record lows after the Iran war. And there you have it. The Strategic Petroleum Reserve dropped to a record low in the week ended May 15, when the U.S. withdrew 9.92 million barrels. Look at all those barrels of oil being pulled out of the reserve. You see on the left-hand side, they never really pulled oil, not money, but pulled oil out of the reserves until the Iran war hit. And shortly after the Iran war, the United States agreed to release oil out of their reserves. And here you have it. And the last, little while, at the end of May, June, we've been hearing that 9.92 million barrels have been released. So no wonder people are starting to think, well, at some point you got to build up those reserves again, and your United States government is going to have to start buying back oil to put it back in their reserves. And again, that could increase the price of oil. Our next chart, an interesting one, shows America's oil reserve is shrinking. So the last chart showed you how much oil is coming out of the reserves. And now this is the number that the reserve has shrunk down towards. And you can see here at one point in time, it was up close to 800 million barrels. Now we're down to about 365 million barrels. So this is the fear. This is the fear out of oil CEOs, company CEOs. This is the fear out of governments, countries. They can only have and use so much of their reserves. At some point, they're going to need to replenish those reserves. They're going to have to need to the need to receive more barrels of oil from the Middle East, from the United States, hopefully from Canada. We hope that they start looking at our country to provide energy or oil, natural gas to countries and not rely so much on the Strait of Hormuz. But there's a lot going on right now, and this is causing the price of oil to rise. And it's overall, it is higher from when the war started. We have a chart on WTI crude, and you can see how much it's been gyrating. But overall, you can see from the beginning of 2026 where the price of oil was, WTI, and where it is today, coming in just under $90. And as you can see at the peak, it was over $110 per barrel. And yeah, the fear is that the longer this war goes, the longer oil remains elevated, the more it's going to increase the cost of living in general, increase inflation, and eventually it will seep into core inflation, which is the difficult one. And that's when you start to hear the words stagflation, which you have a slowing growth in our country, in Canada and the United States, with higher prices. That is what we call stagflation, in a very difficult situation for central banks to navigate, because you don't want to cut interest rates because inflation's high, but you don't want to raise interest rates because growth is anemic or slow. So what do you do as a central bank? And that is the big question. So let's keep an eye on oil. Obviously, it's going to move with what happens in the Middle East. But hopefully, as the president says, President Trump says, we could see a deal between the United States and Iran in the coming days. So does it feel like we are in a recession here in Canada? I guess depending on who you ask, some people may have said feels like we were in a recession a while ago. And that's because growth has been anemic, just over 1% for the longest time, at least for a while now. And now we have gone into officially a technical recession. So the 1% growth has now turned into negative growth or negative GDP, however you want to look at it. And when you have 2 quarters back to back of negative growth or negative GDP, that is a definition of a recession. And I know the CD Howe Institute, we look to them to give us the official word, and they're saying not so fast. I know Bank of Canada is saying yes, but not really. Some are saying, well, yes, maybe that is the case, but that's in the rearview mirror. And this quarter that we're in now is doing much better and will be a positive number. However you want to look at it, it doesn't really matter. The bottom line is this: growth in our country, in the country of Canada, has been low and has gone even lower to the point where we're seeing no growth whatsoever. And that's the bottom line. And we look to our government to try and do something about this. Perhaps, keep lower taxes so that people can keep more money in their pockets at the end of the day. Perhaps the Bank of Canada can cut interest rates lower so that our bills are less, or the money that we're borrowing, whether it's a mortgage, whether it's a line of credit, whatever it is. Maybe the Bank of Canada can cut interest rates so that we're paying less to our creditors or to our loans. And if you combine those two things, then maybe, just maybe, businesses will want to grow again, will become more efficient, will be able to expand or want to expand. And that's really what I've been talking about now for many, many months, but we just don't seem to see our government doing anything about it, which is disappointing. Our first chart here, Canadian GDP growth. You're going to see exactly what I just said. There you have it. GDP growth in the second quarter of 2025, negative 1%. The third quarter of last year, almost 2%. Everybody was excited. Fourth quarter, negative 1. And our first quarter this year was negative 0.1. So just negative. But again, that's not the main message. The main message is we're just not having any growth in our country at this time. Our next chart really shows how things are looking, and that's the quarterly change in GDP in Canada. And oh boy, you can see on the far right-hand side, all you see is red in this bar chart. We can pull it up here, quarterly change in GDP Canada. There you have it. And look, 3 out of the last 4 quarters, which I've just said, have been negative, and this illustrates it perfectly. So if you're not a numbers person, you're more visual. There's no more better visual than that, showing how soft our markets are or how soft our growth is, and our growth has been. So the question I think we all need to ask our provincial government, our federal government, even our municipal government, what are they doing to promote growth in our city, in our province, and in our country? And I think that is a fair question to ask, because clearly we're just not seeing the growth at this time. I know I've talked to Premier Ford. We had Vic Fideli on our show not that long ago. They talked about how much new business is coming to the province. So is it a provincial issue, or is it more maybe a federal issue that we're just not seeing the growth in our country? And so, we are in a technical recession. That is true. But more importantly, I think for all of us as investors, is the growth. And the growth, unfortunately, in this country is just not doing well, and in fact, has slipped into the red. Stocks are driving, the stock market is driving, unbelievable growth for investors, for households. And it's interesting because more and more households are investing more and more money. And we're seeing this, that American wealth is really being generated, created, or enhanced, however you want to call it, from the stock market, due to the stock market. And our first chart clearly shows that investors have gotten the message. We can pull it up here, stock market share of U.S. household assets. So more and more of household assets are moving into the stock market, 33%. And you can see at the bottom here, this has been a chart that goes all the way back to prior to 1960. Basically, just after World War II, this chart goes back towards, since they've been keeping track of this kind of information. And you can see more and more households are investing their money versus doing other things with it. And I think that is happening because of a couple of reasons. Number one, because of lower interest rates. Where else are you going to put your money if you're looking to grow it, right? You can't really put it in a interest-paying 1-year bond, 5-year, even a 5-year bond or GIC. You're making just a few percent. And if you factor in, as the numbers I've already told you, inflation is at around, let's say, 3-4% right now. Making 2-3% just doesn't cut it. After you subtract inflation, your real rate of return is negative. And then you got to pay interest on that, taxes on the interest from that bond or GIC. And so what are you left with? Unfortunately, left with a negative return. So for many households and many investors, they're saying, TINA, there is no alternative. That's what TINA stands for, TINA, to the stock market if we're looking for growth at this time. We're also seeing the stock market at all-time highs. I also believe that is another reason why more and more households are investing money in the markets. Markets are moving higher. People are hearing about it. They have that FOMO. They want to get in. And so that's what they're doing. Fear of missing out is causing them to put more money into the stock market, and they're hearing about their best friends, their cousins, their other coworkers, and they're finding out that they're investing money and making a lot of money over the last little while, and that is bringing in other investors as well. Third point and third reason why I think, and hopefully most investors are using the third and this reason to get into the market, or as a reason to get into the market, is because, as I've said all along and many times, that we invest to get ahead in life, and we work to pay the bills, put food on the table. That's how it goes. And so for those people that aren't investing, living paycheck to paycheck, perhaps, you're being left behind, unfortunately. We talk about a K-shaped economy all the time, right? You have the stick of the K, and then you have the two parts that come into it. And, one part goes up, the other part comes down. And that is the difference, right? those that invest and have wealth are getting wealthier. Those that unfortunately don't have the wealth to invest, unfortunately, they're just remaining stagnant or even falling. So the stock market does unfortunately produce this K-shaped type of situation, K-shaped economy. But we're seeing more and more investors getting involved in the markets to get ahead in life. And that is a good thing. And I'm happy to see that 33%, the highest ever households putting money into the stock market, because I definitely think it makes sense. And I would not be surprised to see that number get closer and closer over the years to 50% going forward. Quick hits. Three things that I've seen in the news recently that I wanted to comment on. First, America's data center build-out is falling behind schedule. We know that the US is building more and more data centers across the whole country, and there are reasons why it's falling behind. We'll touch briefly on that. WWDC 2026, this is Apple's big conference they have in June, every June, and this year was no exception. We were all waiting for what they would say, the enhancements to Siri, bringing AI into Siri and Apple products in general. Well, I think the market wasn't really disappointed, but they weren't really excited either. And we'll talk about that. Iraq and UAE race to establish alternative oil pipelines as exports through Hormuz dry up. As I mentioned briefly a few moments ago, countries are starting to look for other ways to get oil out of the Gulf. UAE, Iraq, using other pipelines to get oil out, not using the Strait of Hormuz. And we've seen more and more of that as of the last, let's call it, few weeks. So let's go to our first quick hit. America's data center build-out is falling way behind schedule, and a lot of reasons for that. I think it's just difficult overall to keep up, and we know that keeping up with AI and keeping up with these data centers is very difficult. The component parts that go into creating or building out a data center is difficult. They're in short demand, short supply, not demand, but short supply, heavy demand, but short supply. And we have an illustration here. Some of the setbacks that we're seeing, other than that, for example, 68% say government must heavily regulate AI, even if it slows development of these data centers. And these are actually Canadians that are saying these things, but we know that Canadians and Americans, surveys have said the same thing. This is an actual Canadian survey, and Canadians call for heavy AI regulation, but 3/4 doubt any government can keep up with the technology. That's the headline of the Angus Reid poll. 74% doubt any government can keep pace with AI. 68% would oppose a large AI data center near their home. Another issue for the data center build out. Obviously, we're seeing these data centers popping up everywhere, but what's happening is costs of energy, costs of electricity are going up in those areas that they're building data centers. And the government is trying to regulate these companies and saying, if you're going to put a data center near, in an area, and the government is saying, the United States government is saying, you need to do things so that electricity prices don't rise. Whatever you're using to build out that data center, whatever you're using for that data center, you got to make sure that you're being efficient and not hurting the population in and around that data center. And so a lot of pushback on data centers. And our fourth point here, 79% support taxing companies that replace workers with AI. That's just a general comment on AI. A lot of people are very sour on AI, especially the younger generation coming out of university, wondering where their next jobs will come from. So overall, data center buildouts, not as robust as once was anticipated in the US, Canada, etc. Next quick hit that we have, WWDC, Apple makes its big splash, AI into their products. Siri's getting a huge upgrade. Basically, what they told us was what they told us a few years ago that they were going to do. Unfortunately for them, it's just taken a few years. Some people will say it's smart because they didn't spend all the money all the other companies did. I don't think it's so smart because I think now Apple has fallen behind all those other companies, and now they have to play catch up. And their announcements, because they were just ho-hum and as expected and nothing revolutionary and nothing no hype behind the announcements. We pull up a chart of Apple. You'll see on the far right-hand side, stock actually fell quite a bit. At one point, it was trading well above $300 a share, and now it's trading below $300 a share. Stock is trading at around, well, 33 times forward earnings, so it's not cheap. But I still am behind Apple. I still believe they're going to make a go out of AI in their products. And at some point, we will start to see the hype around that. And to me, a reason for those on a dip like we're seeing now, perhaps you take a look at Apple stock once again. It used to be the darling of the stock market, I guess, a few years ago. NVIDIA has taken that name now, but or that number one role. But I think Apple can make a comeback as it incorporates AI into their products. Our third quick hit is this idea of countries like Iraq and UAE establishing a pipeline to get around the Strait of Hormuz. And why are they doing that? Our one chart for this idea is no escape for Iraqi oil exports. The volume of tanker deadweight tonnage leaving the ports of Iraq and the UAE through 2026 in metric tons. Look at that fall. That's the amount that exports out of Iraq and UAE have fallen since the war has started and since the Strait of Hormuz has been closed. It's no wonder that they're trying to build out pipelines and use pipelines to get around the strait. We're hearing more and more of this happening. And eventually, it is the hope that 20% of the world's oil does not flow through the Strait of Hormuz as it does now, that we can see that significantly reduced. And I think that would be a very good sign not only for these Gulf states, but also countries like Japan and China and Europe, because they are so dependent on oil leaving this area of the world. What's your take? This is the part of the show where I take one question from our audience, and I actually saw one earlier that came through over the last couple of weeks, and I actually wanted to address it on our show today because I thought it fit in perfectly with sort of the theme of the show. And it reads, I'm retiring in the next 3 to 5 years. Excuse me. What's the best strategy to protect my capital from a sudden market dip without entirely moving to cash and losing out to inflation? Exactly the topic we had, topic one or segment one off the top of the show. And that was talking about the two types of investors. You don't want to pull everything out of the market and lose to inflation and try and time the market, yet you just don't want to let, throw caution to the wind and let everything ride and not be a prudent investor and not have some sort of risk management. So I guess the answer is, as I said earlier, you want to protect your investments by trimming those profits. By trimming those profits, you're not saying that you're getting totally out of the investment idea, because by trimming and leaving a big portion of your money still in that investment idea, you're saying you want that investment to continue to rise. But in case it doesn't, you are starting to realize some of those profits. If that were to pull back, maybe you put money back into that name. But if the stock continues to run, you're a winner as well, because you still have money in that investment idea. You could never go wrong taking a profit. And not only would you have some profits realized, but you're also still in that good quality name for it to continue to ride higher if indeed it can. So for me, I think an active approach of trimming profits when you have them, moving that money into other areas. If you want to be more conservative or lower risk and add more low risk to the portfolio, maybe you take on some bonds for a small component of your portfolio, and you add to that over time with the winnings and just accumulate those, and those will pay interest. Again, keep in mind though, that those winnings or the money you're trimming will not make a lot of money. And in fact, you might actually have a real rate of return that's negative. So got to be careful. Got to be careful what you want to do. But I think taking an active approach makes the most sense. So with that, I want to thank everybody for tuning into our show today. As always, I hope some of you or all of you took something away from our show this afternoon. A lot of information as always, a lot to think about before you make your investment decisions coming up over the next couple of weeks until our next show. And with regards to our next show, we will be on air once again, 12 noon across all social media platforms on Wednesday, June the 24th. And until then, happy investing.